Welcome back, everyone. Today we're going to be discussing the Forex market size and liquidity, along with the different ways to trade Forex, continuing on with our beginners trading series for those of you looking to get into the foreign exchange markets. So before we do get into that, for those of you guys who are new here, this channel focuses on comprehensive financial education for traders and investors. And for those of you guys who are looking to get started trading, go ahead and browse the description below for various resources provided to assist you in that process. For example, our free Discord community, where we provide daily Forex trading signals absolutely for free. Along with that, you get a community of people looking to trade and succeed in the same exact market, and a lot of extra information and resources that will be provided to you as the community continues to grow. So with that out of the way, let's go ahead and get started. So what is Forex? That's what we're discussing in this video. That's what we discussed in the first lesson. And again, guys, this is following the curriculum of the babypips.com trading course. That's absolutely free. However, it is a course that you have to read through. So I wanted to put it on the channel in video format for those of you guys who would rather prefer to watch a video instead of read through it. But I always recommend going to each page associated with the lessons that we discuss on these videos. Go over onto the website and just complete the pages corresponding with the videos as we go through them. And again, all of the information will be credited to babypips.com. So definitely go ahead and give that website a check to see if you guys like it. I certainly do. That's where I started learning my Forex education, and that's definitely where I recommend starting as well, which is what we're doing right here. So getting into it, Forex market size and liquidity. So the Forex market size has neither a physical location nor a central exchange. It is considered an OTC, which is over the counter, or interbank market, due to the fact that the entire market is run electronically within a network of banks continuously over a 24-hour period. Now, we discussed in the first lesson that the Forex market is open 5 days a week, 24 hours a day during those days. This means trades can take place anywhere and any time as long as you have an internet connection. In an OTC market, participants determine who they want to trade with depending on trading conditions, attractiveness of prices, and the reputation of the trading counterparty. So this is a little chart that I wanted to display for you guys. And again, this chart is provided by babypips.com, and it is basically a currency distribution in the FX market. So it shows which currencies are traded the most. And just to give you guys a little bit more of an idea, the percentages add up to 200% since all pairs that you're going to trade, there's a currency on each side of the pair, so these percentages do add up to 200%. But as you can see, the USD, the Euro, the Yen, and the Pound, those are the top 4 currencies that you're going to be seeing traded in this market. So as you can see, the dollar is king in the Forex market. Now, according to the International Monetary Fund, which is the IMF for short, the US dollar comprises roughly 64% of the world's official foreign exchange reserves. Other significant reasons why the US dollar plays a central role in the Forex market include the largest economy in the world, it's the reserve currency of the world, it's the most liquid financial markets in the world, it has stable politics. Now, I know some of you may disagree with that, but it's also the sole military superpower, and of course, the medium of exchange for cross-border transactions. So speculation in the Forex market, that's actually what most of you guys will be doing. It's what all retail traders are doing. We're actually speculating in the market. So one important thing to remember is that the whole commercial and financial transactions are part of the trading volume. Most currency trading is based on speculation. So to elaborate a little bit more, most of the trading volume comes from traders that buy and sell based on intraday price movements and based on where they expect things to move, right? So the trading volume brought about by speculators is estimated to be more than 90%. The scale of the Forex market means that liquidity, the amount of buying and selling volume happening at any given time, is extremely high, which makes it very easy for anyone to buy and sell currencies. So to just get into this a little bit more, for those of you guys that may have traded in other markets, let's say the stock market or cryptocurrency markets or anything like that, liquidity is very important because, as you know, let's say the price of something is $1, the bid is $1, and the ask is $1.01. That's pretty liquid because there's a very small spread, right? But if you can sell something for $1, but then you have to buy it for $2, that's not very liquid because you're basically buying it for 100% more because there's not a lot of buyers and sellers. So in the Forex market, simply put, there are tons of buyers and sellers, which makes it extremely easy to get in and out of positions with very large amounts of trading capital. So again, as a trader, liquidity is very important because it determines how easily price can change over a given time period. A liquid market environment like Forex enables huge trading volumes to happen with very little effect on price or price action. So some of the different ways to trade Forex, well, there are various ways in which you can invest or speculate in currencies. However, there are 4 options that are the most widely used, and they are as follows. So the examples are spot Forex, which is where you'll most likely start, and that's where I focus on myself. There's currency futures, there's currency options, and there's currency exchange traded funds or ETFs. So starting off with currency futures, futures are contracts to buy or sell a certain asset at a specified price on a future date. So since future contracts are standardized and traded on a centralized exchange, the market is very transparent and well regulated, which means that price and transaction information are readily available. Currency options. An option is a financial instrument that gives the buyer the right or the options, but not the obligation to buy or sell an asset at a specified price on the option's expiration date. If a trader sold an option, then they would be obliged to buy or sell an asset at a specific price at the expiration date. Similar to futures, options are also traded on an exchange, such as the CME, ISE, or the PHLX. The disadvantage, of course, though, to trading Forex options is that market hours are limited for various options and the liquidity is not nearly as great as the futures or spot market. Currency ETFs, so exchange traded funds, which are the youngest option out of all of the 4 in the Forex world. A currency ETF offers exposure to a single currency or basket of currencies. ETFs are created and managed by financial institutions who buy and hold currencies in a fund. They then offer shares of the fund to the public on an exchange, allowing you to buy and trade these shares just like stocks. So similar to currency options, the limitation in trading currency ETFs is that the market isn't open 24 hours, and there are various commissions and transaction costs that come along with it as well. So lastly, we have the spot Forex market. And the spot Forex market allows currencies to be traded immediately or on the spot using the current market price. And this method allows for simplicity, liquidity, tight spreads, and round-the-clock operations. And it is also very easy to begin trading in the spot market with as little as $50, sometimes even $10, depending on the brokerage. Of course, I don't recommend starting off with $10 or even $50. Normally, I would recommend starting off with $500 or $1,000 minimum. But again, you can, if you really wanted to, start off with $100 on at least dip your toes in. But if you want to just dip your toes in, I always recommend starting off with a paper trading account, which is a demo or a fake virtual account, so you can at least learn how to become consistently profitable before you actually put real capital at risk. So guys, those are the 4 different ways to trade Forex. And for me, I love the spot Forex market. It has a ton of different advantages, which we're going to continue to get into later on throughout the lessons. But those are some of the other ways as well. We have futures, options, and ETFs. Now, the problem with those is they're not going to be open 24 hours and they don't exactly operate the same way as the spot Forex market does, which again, we'll get into a little bit later. But I wanted to give you guys a little bit of an overview about all of the different options you can consider as you continue to grow and learn as a trader. You may want to explore some of these different options a couple years down the line when you've had a ton of experience in the spot Forex market, which again is where I recommend always starting out. So that's going to be the end of this lesson, guys. So I hope you guys enjoyed this one. Again, just going over some of the more fundamental parts of the market. Now now we're going to be getting into some of the more advanced topics as we continue to move on. So hope you guys enjoyed, and I will see you guys in the next lesson.